Imagine waking up in a hospital recovery room, right? Your throat is just raw from the intubation tube. Your neck is locked in this rigid brace, and you've just undergone a massive, super invasive spinal fusion.
Oh, wow.
And
Yeah.
you went through all of that pain because, you were told it was literally the only way to fix a nagging injury.
Right.
But what if you found out later that the tissue the surgeon removed from your spine was perfectly healthy? Like, what if that surgery had absolutely nothing to do with actually healing you and everything to do with inflating the value of a Wall Street financial derivative?
I mean, it sounds like a dystopian sci-fi plot, honestly. You're basically turning a human body into a collateralized asset.
Exactly.
But when you look at the mechanics of the third-party litigation funding industry, particularly, the really extreme end of it, that exact scenario isn't fiction. It's a business model.
Welcome to the deep dive. We've got this massive stack of notes, research, and, source material today, all centered around a pretty explosive federal legal complaint. It was filed in the Southern District of New York.
Right. It's New York Marine and General Insurance Company v. Cash-Funding, LLC.
Yeah, that's the one. And our mission today is to really pull this apart because it exposes this industrialized shadow litigation machine that's just operating right underneath the normal civil justice system.
Yeah, completely hidden in plain sight.
And I'll say this right up front. If you've ever looked at your auto insurance premiums or your business liability rates and wondered why they just seem to defy gravity every single year, this document alleges that this invisible engine is part of what's driving those costs up.
Because, we always assume the legal system operates on a relatively simple equation, like injury plus liability equals compensation.
Right. Someone gets hurt, they get paid.
Exactly. It's adversarial, sure, but the parties involved are the ones actually in the dispute. But what we are looking at today is an entirely different ecosystem. We're talking about private equity and institutional investors literally injecting capital into lawsuits just to extract a yield.
Which changes everything.
It does. When you introduce that kind of profit motive, the incentives of the whole justice system warp in ways that are, frankly, deeply unsettling.
Okay, let's unpack this. Because the central architect in this specific operation, according to the complaint, is a suspended attorney named Gregory Alefterakis.
Right.
And he allegedly built this massive, vertically integrated barratry operation. Now, barratry, for anyone who hasn't, brushed up on their medieval common law recently.
Which is most of us, I'd say.
Yeah, exactly. Barratry is the illegal incitement of lawsuits. They aren't just sitting around waiting for accidents to happen. They are allegedly manufacturing the volume.
And that volume is the key to the whole thing. If you're running a financial institution, which is what Case Cash effectively is, you cannot rely on the random variance of people tripping on sidewalks or getting into fender benders.
It's too unpredictable.
Exactly. You need a predictable, scalable pipeline of raw material. And in this case, the raw material is plaintiffs.
Right. And they allegedly just buy that raw material outright. I mean, there are actual canceled checks in the evidence here.
Yeah, seeing the checks really makes it real.
It really does. There's a check for $10,200 and another for $11,900. And they were cut from a Case Cash entity directly to a medical clinic called StarMed.
And, in his deposition, Alefterakis was remarkably candid about the math behind those checks. He testified under oath that the going rate was about $1,500 per referral.
Wait, so if you do the math on that $10,000 check isn't paying for, like, an MRI machine or medical supplies?
No, not at all.
That is effectively a receipt for purchasing 7 human beings to feed into their litigation pipeline.
It's an acquisition cost. That's exactly how they treat it. But, acquiring the injured party is only step one.
Right.
You need a venue to monetize them, which means you need captive law firms to actually file the suits and then steer the clients back to the funding company.
And this is the part that genuinely blew my mind. Alefterakis admitted, again under oath, to giving out these, quote, personal loans to up-and-coming personal injury attorneys.
Right.
But these weren't standard commercial loans. They were completely interest-free, and they had absolutely no fixed repayment date.
Think about the psychological leverage that creates, though. If I give you a massive, open-ended, interest-free loan, you are entirely beholden to it.
Oh, absolutely. I'd feel like I owed you my life.
Right. And Alefterakis literally called this practice the, quote, final piece of the puzzle. He knew it made the attorneys feel obligated to direct their clients to take out cash advances from case cash.
Clients who implicitly trust their lawyer for advice.
Exactly. The attorney's fiduciary duty to their client is completely overridden by their financial debt to the funder.
And then you look at how Case Cash actually markets these cash advances to the victims themselves. Their website is just plastered with promises of guaranteed approvals, and they boast about their experienced underwriters.
Right. They try to sound very official.
But the employee roster tells a completely different story. According to the complaint, there isn't a single underwriter on staff. It's entirely executives and customer service reps.
Which fundamentally redefines what this company is actually doing, because an underwriter's entire function is risk assessment.
Right.
If a legitimate litigation funder is looking at a case, an underwriter is going to evaluate the liability, the police reports, the medical files, and they calculate the probability of a plaintiff verdict. They are making a real investment decision based on merit.
Wait, so if they are promising guaranteed approvals and they literally don't employ anyone to assess risk, aren't they basically just a cash register with a website masquerading as a financial institution? I mean, they're just a volume processing center.
That is the critical distinction, yeah. They aren't evaluating risk because they've already rigged the variables. If you control the clinic supplying the plaintiff and you control the lawyer filing the suit, the merits of the actual accident are totally secondary. You are just processing the paperwork to create the financial instrument.
Wow. And, if this were just a paper scheme like kickbacks and compromised lawyers, it would still be a massive financial fraud, but it would remain kind of abstract.
Sure.
But here's where it takes a dark physical toll on actual human beings. To maximize the value of these financial instruments, they need the underlying lawsuits to be worth millions, not thousands. And how do you instantly multiply the value of a personal injury claim?
You increase the medical severity. Actuarial tables at insurance companies are incredibly rigid.
Yeah.
So a soft tissue injury like a sprain or a bruise has a hard ceiling on its settlement value.
It's just not worth that much on paper.
Right. But surgical intervention, especially spinal surgery, blows the lid right off the policy limit.
So Case Cash allegedly made their cash advances explicitly contingent on the plaintiffs undergoing these serious surgeries. There are actual funding agreements where the fine print literally states a specific dollar amount is only payable post-surgery.
That's terrifying.
They literally withhold the cash until the person lets a surgeon cut into them.
And we have to remember who the targets of this operation are.
Yeah.
They aren't, financially stable professionals. You really have to look at the testimony of Wandy Diaz from a related criminal trial.
Right. I remember reading that part.
She was asked on the stand if she received money after undergoing a back surgery. She confirmed she did. Then she was asked the amount. $1,000 from Case Cash.
$1,000. I mean, that is a rounding error for these companies, but for someone who is truly desperate, it's life-changing money in the short term.
Exactly. Federal Judge Stein, who presided over that related trial, put it perfectly during the sentencing phase. He pointed out that no person with a job, an education, and the ability to support their family is going to agree to an unnecessary spinal fusion for $1,000.
No, of course not.
The whole essence of this conspiracy relies on finding the down and out, the homeless, the utterly desperate. You are exploiting extreme poverty to manufacture surgical damages.
Which brings me back to Esmarlin Polanco, the 18-year-old kid I mentioned at the start of the deep dive.
Yeah, his story is just brutal.
It really is. He shows up to a hospital, right? The EMTs log a bruised right knee from a trip and fall. No complaints of neck pain whatsoever. And a bruised knee is worth practically nothing in the grand scheme of this pipeline.
But once he enters their ecosystem, the narrative shifts entirely.
Completely. This young kid gets funneled through the system and eventually undergoes 2 cervical spine fusions. They fused the vertebrae in his neck.
Over a bruised knee.
Yes. And we know that at least one of these operations was funded directly by the defendants. But the absolute kicker is the pathology report. After the first surgery, the lab tested the tissue they removed from his spine.
Yeah.
It was completely 100% healthy.
The physical mutilation is staggering. But, you also have to look at the coordination around him. He wasn't an isolated incident at all.
No, not even close.
Virtually every adult in his orbit, his relatives, his roommates across 2 specific addresses, they all suddenly had trip and fall claims.
What are the odds?
Exactly. And they were all represented by the exact same small group of compromised attorneys. Over a third of them received identical surgeries from the exact same surgical group. I mean, one of his Marlon's cousins even had an operative report that was copy-pasted verbatim from someone else's file. It is a literal factory floor.
It's an assembly line.
Yeah.
They take a bruised knee, run it through the surgical mill, and out the other side comes a high-yield financial asset. The surgery isn't about healing. It is literally about collateralizing the loan.
And once that collateral is secured, once the healthy tissue is removed and the surgical hardware is installed, the physical manipulation ends and the financial trap snaps shut.
Right.
Because these companies don't just want a decent return on their $1,000 advance. They want the entire settlement.
Yeah, let's look at the math on how they actually extract that money, because the industry calls these non-recourse advances. The premise is that if the plaintiff loses the case, they owe nothing. And because the funder assumes that risk, they argued this isn't technically a loan, which conveniently exempt them from state usury laws that usually cap interest rates.
It's a classic regulatory arbitrage. By defining the product as an investment rather than a loan, they basically strip away all consumer protection laws.
And the result of that loophole is just catastrophic for the victims. Look at the case of Nasir Ahmad Doost. He's an Afghan refugee, doesn't speak English. He was allegedly led to believe he was getting a $25,000 COVID relief loan at a standard 3.5% interest rate.
He thought he was dealing with a normal bank.
Exactly. But when his injury case finally settled, his own attorneys bypassed him entirely. They issued a check straight from his settlement to Case Cash for over $67,000. Yeah, that translates to an effective interest rate of 170%.
170%. It's practically extortion.
It really is. And the local community center was so horrified they actually escalated it to the district attorney. But taking a massive cut is only half of the control mechanism. The other half is that they allegedly refuse to let these cases settle until their arbitrary profit margins are met.
This is where we cross from aggressive financing into absolute control of the judicial process.
Right.
There was a case in the complaint, the Peralta matter, where everyone actually came to the table. The plaintiff, the defense, the insurers. They hit mediation and agreed on a totally fair market settlement of $750,000.
But Case Cash stepped in and vetoed the deal.
They blocked it entirely. And look at their financial stake in it. They had advanced only $76,500 to the plaintiff, but they slapped a massive lien on the case for over $1.4 million.
That's insane.
Because their manufactured lien was higher than the settlement offer, they just refused to sign off. They forced a resolved case to remain in the clawed court system purely to squeeze out more yield.
I genuinely do not understand how that is legally permissible. Like, if I finance a car, the bank holds a lien on the title. If I decide to sell that car for its Kelly Blue Book value, the bank doesn't get to block the sale just because they wanted me to hold out for double the price.
Right. That would be absurd.
So how does a third-party funder have the authority to step in and veto a settlement between an injured victim and an insurance company?
Well, the short answer is they shouldn't. This strikes at the heart of an ancient legal doctrine called champerty.
Champerty?
Yeah. Champerty essentially prohibits a third party from buying into a lawsuit with the intent of controlling it for their own profit. The justice system relies on the actual adversarial parties, the person hurt, and the person who caused the hurt making the decisions.
Judging them independently.
Exactly. If a shadow financier is pulling the strings and vetoing settlements, the lawsuit is no longer about justice or making the victim whole. It's just a proxy war for an investor's return on investment.
And they were incredibly brazen about managing these proxy wars. They had an employee, Shirin Moini, who was caught directly emailing defense insurance adjusters.
Yeah, leaving a paper trail.
She was demanding case updates, asserting litters, effectively acting as the plaintiff's manager. They weren't passive investors waiting for a check. They were actively driving the litigation.
And when you actively drive the litigation with 170% interest rates and these manufactured litters, the ultimate victim is the person who actually suffered the injury.
The math on the Sanchez-Fuentes case is the perfect encapsulation of this. The system finally generates a massive settlement, $3.75 million.
Right, which sounds like a huge victory.
You hear that number and think the severely injured victim is set for life. But after the dust settles, the victim walks away with just 13.3% of it, about $500,000. The lawyers take almost $1 million.
And Case Cash.
They siphon off nearly 48% of the gross settlement. Over $1.78 million goes straight to the funder.
The victim assumes all of the physical risk, The surgeries, the permanent bodily alteration, and the financier reaps the lion's share of the reward. It completely inverts the entire purpose of civil compensation.
So we have an operation that is paying $10,000 kickbacks to clinics, issuing massive interest-free loans to attorneys, advancing thousands of dollars to desperate plaintiffs, and floating all these costs for years while cases drag through the courts.
It takes a lot of money to keep that going.
Exactly. That requires a staggering amount of liquidity. Gregory Alefterakis, a suspended lawyer, does not just have that kind of capital sitting in a checking account. So where is the upfront money actually coming from?
It comes from Wall Street. To fund an operation of this magnitude, you really have to utilize sophisticated financial engineering. Case Cash isn't just holding these 170% interest advances on their own balance sheet. They are utilizing securitization.
Okay, wait, break that down for me. How do you securitize a bruised knee?
Think of it like a massive meat packing plant. If you take thousands of individual personal injury advances, some good, some bad, some highly inflated through surgery, and you grind them all up together, you create a new, singular financial product.
Ah, I see.
You pool these personal injury receivables, and you sell them as rated asset-backed securities to outside institutional investors.
So it's essentially the exact same mechanic as the subprime mortgage crisis.
Yes, precisely the same mechanic.
They are taking incredibly toxic, high-risk assets, in this case, human suffering and manufactured lawsuits, packaging them into shiny financial derivatives, getting them rated, and selling them to hedge funds and pensions.
And when you look at the 2022 securities report for this operation, which is cited in the complaint, the illusion of this being a broad, diversified financial product completely falls apart.
What did the report say?
Over 50% of Case Cash's outstanding receivables, nearly $44 million, were concentrated among just 3 law firms.
Wait, $44 million of Wall Street capital deployed through just 3 captive law firms.
Yes, that metric is the smoking gun here. A healthy, diversified litigation funding portfolio would have thousands of independent attorneys accessing capital for unique, organic cases.
Right.
A 50% concentration in just 3 firms proves this is a closed-loop system. It is a highly coordinated mill designed to predictably extract capital.
And who are they extracting it from? Because the investors buying these asset-backed securities aren't stupid. They know these victims don't have the money to pay back a $1.4 million land-in. They know the money has to come from somewhere reliable.
Which brings us full circle to why New York Marine and General Insurance Company is the one filing this complaint. In the actual securitization documents, the prospectus given to Wall Street investors, specific insurance companies, are explicitly named as the, quote, payment source.
Wow.
The insurers aren't collateral damage. They're the designated extraction points. The investors are buying these derivatives with the guaranteed expectation that the insurance companies will be legally forced to pay out these inflated, surgically enhanced settlements.
So, what does this all mean for you listening? Let's take a step back and really look at the monster we've just dissected today. We're looking at a single legal complaint that outlines an enterprise that allegedly bribes medical clinics to secure human raw material.
Yeah.
It compromises lawyers with zero-interest loans to guarantee loyalty. It preys on people living below the poverty line, dangling cash in front of them, but only if they agree to undergo invasive, medically unnecessary spinal surgeries.
It's just horrific.
It traps those victims in regulatory black holes with 170% interest rates, vetoes their attempts to settle fairly, and then grinds up all of that human misery into a financial derivative sold to Wall Street.
And the cost of that entire machine is socialized. Wall Street gets its yield, the funding executives get their millions, the captive lawyers get their fees. But the insurance companies paying out these inflated settlements do not just quietly absorb those losses.
Right.
They recalculate their actuarial tables, and they pass every single cent of that extraction onto the public.
It is a hidden shadow tax on every person listening to this right now. If you drive a car, if you own a small business, if you rent an apartment, your premiums are subsidizing the returns on these securitized lawsuits.
Understanding the plumbing of this system is really the only way to understand why the civil justice system feels so broken and expensive. The congestion in the courts and the skyrocketing premiums aren't just natural inflation. They are the byproduct of industrialization.
And that leads to a deeply unsettling reality about visibility. Because if this is a Wall Street machine, acting like a shadow bank, you would think there would be a public ticker, some sort of required disclosure so we could see who actually owns the lawsuits clogging our courts.
You would think so.
But the source material highlights this terrifying loophole. Unlike legitimate regulated lenders who file UCC financing statements to publicly register their financial interests, Case Cash explicitly avoids filing them.
By intentionally keeping their financial stakes off the public record, they operate entirely in the dark. A judge, a jury, even the opposing counsel has absolutely no idea that a private equity vehicle is actually steering the case.
It really makes you question everything you see in the legal system
Mhm.
because, you walk into your local courthouse today and you see a docket thousands of cases deep. You look at a lawsuit and see a plaintiff who tripped on a sidewalk and a defendant who owns the property. It looks like a straightforward, organic human dispute.
Right.
But because this industry actively hides its paper trail, it leaves you with a chilling question to mull over. How many of those thousands of cases are actually real? And how many are just financial puppets secretly mastered from the shadows by hidden litigation funders? We really won't know until the lights are finally turned on.